Reference rates are commonly used to link payments in a wide variety of financial contracts, such as loans or mortgages or interest rate derivatives. And by standardizing the process, it helps to make financial markets more efficient. And at least since the 1950s, the Federal Reserve Bank of New York has been administering and producing the effective federal funds rate. And more recently, we started to produce the overnight bank funding rate. So when we took on the challenge of producing 3 new Treasury repo rates, we did have a good sense of the type of issues that we would confront. These 3 new repo rates will be fully in compliance with international best practices. Some of the things that we're focused on in order to do that is making sure the data is fully robust, that it's representing the market as a whole. I mean, we'll be pulling data to produce these rates from 3 different segments of the repo market. We're making sure the business process is well governed. We're going to be fully resilient to potential contingencies, both in terms of the technology we're using to produce the rates and also in the staffing, so the market can be very confident that the rates are robust and will be durable over the long run. Of the 3 Treasury repo rates, SOFR will be the one that's most well known. The Alternative Reference Rate Committee recommended last year that market participants transition from LIBOR to this SOFR rate. Market participants need to be focused on this issue because there are some risks that LIBOR may not be available as a reference rate after 2021. We've been focused really on communicating 3 things. First, it's important that market participants assess their full exposure to LIBOR. Second, they need to begin to develop transition plans for areas where they do have exposure. And lastly, they need to be reviewing their financial contracts to make sure that there's a robust fallback should LIBOR leave earlier or unexpectedly, or for any other reference rates that they're relying on, that they have a robust backup for them inside those financial contracts. We're working with market participants to encourage them to begin to prepare for a world without LIBOR.